Quanta Services stock target price forecast and full valuation analysis, May 2026, by Value and Momentum Portfolio. Welcome back. Let's talk about Quanta Services, ticker PWR. The stock has gained nearly 70% so far this year, and it's sitting at $733.62 as we record this. That kind of move demands an explanation, and more importantly, it demands a real look at whether that price still makes sense. So today we're going to walk through the full picture, what the business actually does, where the competitive edge comes from, how the numbers stack up, and what the valuation is really implying. Let's get into it. Here's the core argument for Quanta right now. The market sees it as a straightforward utility contractor or a data center play. We think that framing misses something important. There's an amortization cliff coming. Quanta has done a lot of acquisitions, and those deals create non-cash charges that drag reported earnings down. As we get toward 2028, those charges start rolling off. GAAP earnings and adjusted earnings, which have been running very far apart, should start converging. The market isn't pricing that in clearly yet. There's also a major technical capability here that most people underestimate: 765 kilovolt ultra-high voltage transmission work. Quanta is one of a very small number of companies in the world that can actually do this, and there's a lot of it coming. CEO Duke Austin confirmed that he expects significant bookings for this work in the second half of 2027. The company has also moved from being a plain contractor to being what they call a long-term infrastructure partner. That shift changes the revenue profile and the margin profile, but it also adds complexity and risk. We'll come back to that. Company overview. Let's quickly set the scene. Quanta is based in Houston. They've been running since 1997. Most of the business is in the United States, with some operations in Canada and Australia. They design, build, and maintain electric power infrastructure, transmission networks, substations, smart grid technology, emergency restoration. About 69,500 employees total. The business runs in two official segments: electric and underground utility, though we find for a more useful breakdown. Electric power infrastructure is the biggest piece, around 48% of revenue. Most of that work, roughly 85%, comes from long-term maintenance agreements. Renewable energy is about 28% of the business. Underground utilities make up the remaining 24%. What sets them apart is people. They own the Northwest Lineman College. They train their own specialized workforce while everyone else is competing for the same scarce talent pool. Their total backlog sits at $44 billion, which gives them a lot of visibility on future work. Moat and pricing power. This is where Quanta gets interesting. We'd call this a narrow moat. It's a genuine competitive advantage, but it requires constant reinvestment to defend. Their scale is part of it. 69,500 people across North America locks out smaller players for big multi-billion-dollar projects. Utilities like NextEra or Duke Energy need that certainty. They're not going to hand a $3 billion transmission contract to a regional outfit. Quanta also holds patents for energized services, the ability to work on high-voltage lines while the power is still running. That avoids outages. It's technically demanding, and most general contractors can't touch it. On pricing power, their gross profit margins dipped to 14.1% back in 2023, but they bounced back to 15.0% by early 2026. In Q1 2026, their operating margins grew by 170 basis points. Revenue grew 26% year over year in the same quarter. Even as they raise prices, demand holds. That's a solid signal. Their backlog of $44 billion is much larger than the roughly $13 billion at Mastech or the roughly $11 billion at Primoris. That gap reflects both scale and customer trust. Two real risks to pricing power, though. First, about half their revenue comes from fixed-price contracts. If inflation spikes on materials, especially transformers, those margins can erode quickly. Second, there's a regulatory risk. If utility rate increases get blocked, customers might look for cheaper alternatives. Those are the scenarios to watch. – Price action, brief technical note. The stock is at $733.62 today, up 114% over the last year and 55% since January. This is a parabolic uptrend. The stock is well above both the 50-day moving average and the 21-day exponential moving average. There's a firm base around $240 to $260 that formed during the Q1 2025 drawdown. More recently, the $560 to $580 range has transitioned from resistance into support. Momentum is rising with no divergence signs. Institutional volume confirmed the most recent breakout, but the extension from the mean is real. Any negative catalyst could trigger a reversion. Operational performance. Revenue trajectory. Revenue growth has gone through several distinct phases. In late 2023, the company was running $5.6 to $5.8 billion per quarter, with year-over-year growth around 30%. Then in 2024, it decelerated to 10% to 16%. By 2025, it re-accelerated. Full year 2025 revenue was $28.5 billion, up 20% year-over-year. And Q1 2026 came in at $7.9 billion, a 27% growth rate, the fastest pace in 5 quarters. It's important to understand how much of that growth came from acquisitions. Cupertino Electric, Dynamic Systems, Tri-City Group, Wilson Construction. These deals distort the year-over-year comparisons. If you strip out acquisition effects, true organic growth is probably running in the 10% to 14% range. We estimate that roughly 40 to 55% of the growth seen across 2024 and 2025 was driven by M&A. Cupertino Electric alone likely added between $1.5 and $2.5 billion on an annualized basis. Free cash flow quality. One genuinely encouraging part of the story is the quality of free cash flow. Full year 2025 free cash flow was $1.7 billion on $28.5 billion in revenue, roughly a 6% free cash flow margin, and consistently, free cash flow exceeds GAAP net income by a factor of 1.3 to 3.7 times. That gap is driven by non-cash charges like depreciation and intangible amortization. So while reported earnings look weighed down, the underlying cash generation is solid. Leverage in the balance sheet. Total debt has risen from $3.7 billion in Q1 2024 to $6.0 billion by Q4 2025. That's a 62% increase in 7 quarters. Management reports a leverage ratio below 2 times using last 12 months adjusted EBITDA of $2.9 billion. That's manageable, but the absolute debt level has gone up significantly, and that matters if conditions change. One thing we're watching closely, GAAP operating margins have stayed essentially flat despite strong revenue growth. There's a persistent 33 to 46% gap between GAAP and adjusted earnings per share, and that gap isn't narrowing. The amortization from acquisitions keeps it wide. That's not a crisis, but it is a structural reality investors need to understand. Backlog. The backlog trajectory is positive. At end 2022, it sat at roughly $19 billion, about 1.1 times revenue. Today, it's $44 billion at end 2025, and the ratio has expanded to 1.54 times revenue. That's roughly 18 to 19 months of forward revenue already on the books, which is above the historical norm for this type of contractor. Some of the increase is from acquired backlogs, but the underlying demand acceleration is real. Valuation. DCF analysis. We're using a risk-free rate of 4.4% and an equity risk premium of 5.5%. Our base case cost of capital is 9%. Bear case is 10.5%. Bull case is 7.5%. In our base case DCF, we get a share price of $578. That's about 21% below where the stock is trading today. The bear case drops to $354. The bull case reaches $1,003. Here's the critical question. What does the current price of $733.62 imply? Working backward through a reverse DCF, the market is pricing in a free cash flow CAGR of 29.7% over the next 5 years. That means the company needs to generate $6.6 billion in free cash flow by 2030, nearly 4 times the $1.7 billion it generated in 2025. Revenue would need to reach somewhere between $60 and $73 billion. The revenue growth assumptions, at 15.6% to 21.6%, aren't unrealistic given the 18.5% historical average. The hard part is the margin expansion. The current price assumes free cash flow margins go from 6% today up to 9% to 11%. That's a significant lift, and it depends heavily on the Vert Supply Transformer Manufacturing Initiative delivering real results. Trading multiples versus peers. On a peer comparison basis, the stock trades at 34.2 times next 12 months EBITDA versus a peer median of 22.9 times. That's a 49% premium. On price to free cash flow, it's 61.2 times versus a peer median of 19.7 times. Though that's temporarily distorted by the Vert Supply capital cycle. The adjusted PEG ratio is 2.44 times versus 1.29 times for peers. The premium is real and it's large. Some of this premium is justifiable. Quanta operates at $33.5 billion in expected revenue with a projected growth rate of 17.5% versus roughly 15% for peers. The $44 billion backlog and structural demand tailwinds warrant some premium. But after weighing strengths against the below cost of capital ROIC and a free cash flow, yield below the risk-free rate, we think a justified premium is 30% to 40%. The current 49% premium looks stretched. Sum of the parts. For our sum of the parts analysis, we break the business into 4 segments: core electric transmission and distribution, renewable energy EPC, underground utility, and data centers. Looking at 2026 numbers, our implied base case share price comes out to $439. The high end reaches $563. Both are well below the current price. That gap, roughly $170 per share, or about $25.5 billion in market cap, is what the market is calling a platform premium. Future value from 765 kilovolt bookings, Vert Supply, and scale that doesn't exist in the numbers yet. When we run the sum of the parts model forward to 2028 using a 17.5% revenue growth assumption, consistent with the 18.5% historical average, the implied price range moves to $698 to $790. That's where the current price of $733 sits, squarely inside the 2028 range. The market is paying today for EBITDA performance it expects to see 2 years from now. Monte Carlo. Our Monte Carlo simulation ran 10,000 paths out to 2028, using a mean revenue growth rate of 17.5% and a mean adjusted EBITDA margin of 11.5%. The average implied price came out to $735, essentially where we're trading. The median was $713, meaning more than half of all scenarios produced a price below today's level. The fifth percentile outcome is $474, a 35% decline. There's a 42% probability of the stock trading below $733.62 under our model. Required returns and margin of safety. If you buy at $733.62 today and hold for 2 years, our base case produces an annual return of negative 2.4%. Over a 5-year hold, the base case improves to positive 6.4% per year, barely above the 4.4% risk-free rate. To hit a 15% annual return in the base case, you'd need an entry price between $500 and $544, a 26% to 32% discount from today. For a 20% return, you'd need to be in at $405 to $485. The stock requires near-perfect execution through 2028 just to justify the current price. There is effectively no margin of safety. Risks. 3 structural margin risks. First, craft labor inflation. You have 69,000 employees in a tight skilled labor market. The CEO said it plainly. Data centers are probably the tightest labor market right now. Higher wages hit margins, and Quanta's self-perform model amplifies that exposure. Second, fixed price cost overruns. As data center contracts get larger and more complex, cost estimates become harder. The company reported $983.6 million in unapproved change orders at end 2025. Revenue already recognized that customers haven't formally agreed to pay. That number needs monitoring. Third, the VERT supply capital cycle. The company is investing between $500 million and $700 million in transformer manufacturing, with $250 to $350 million of that hitting in 2026. The margin benefit accrues in 2027 and beyond. The depreciation headwind starts in 2026. That's a 12 to 24-month window of absorbing costs before the return arrives. Balance sheet and off-balance sheet risk. There's $14.9 billion in performance bonds outstanding as of December 31st, 2025. That's more than 50% of annual revenue and contingent liabilities. Any material project failure could convert those into immediate cash pressure. That's the most significant off-balance sheet risk in the story. There's also the 33 to 46% GAAP to adjusted EPS gap. If the stock stagnates, the company either pays more in cash compensation, which pressures margins, or issues more shares, which dilutes existing holders by an estimated 3 to 5% annually. Insider activity. CEO Earl Austin sold $120.2 million in stock on May 5, 2026. That's 155,000 shares, reducing his personal holdings by about 18.6%. This happened 1 week after the strong Q1 earnings beat. Large insider sales can be pre-planned, but given the valuation, it's a data point worth keeping in context. 3KP is that would break the thesis. KPI 1, GAAP operating margin falling below 4%. That would signal acquisitions are adding revenue without adding profitability. KPI 2, unapproved change orders rising above 5% of annual revenue. From the current $983.6 million, that threshold is roughly $1.5 billion. KPI 3, organic backlog growth falling below 7% for 2 consecutive quarters, which would suggest the structural tailwinds are being overstated. Potential upsides not yet in the price. To be fair to the other side, there is real potential value that isn't yet reflected in the stock. 765 kilovolt bookings are the biggest driver. Today, there is $0 of this work in the $44 billion backlog. Duke Austin expects these to hit in the second half of 2027. We estimate this driver alone could represent $80 to $150 per share in value if it materializes. Gas power contracts expected before the end of 2026 could add another $25 to $40 per share. VERT supply, if it delivers, is worth $50 to $100 per share. AI productivity tools being rolled out across 2,000 plus engineers could add $15 to $25 per share over time. When we weight all 8 identified upsides by their probability and integrate them into the model, they represent roughly $196 per share. That shifts our adjusted base case from $698 to $894. Bottom line and recommendation. Here's where we land. The long-term thesis on Quanta is solid. The power grid needs meaningful investment over the next decade. Data centers are a structural growth driver. The company has real competitive advantages in labor, scale, and technical capability. Free cash flow quality is genuinely strong. But the current price is already pricing in a very specific future. Free cash flow growing almost 4 times in 5 years. Margins expanding from 6% to 9% to 11%. 765 kilovolt bookings that haven't happened yet. The NiSource 3 gigawatt project moving from announcement to contracted backlog. All of that needs to materialize to justify $733.62. The risk to reward at this price is 0.54 to 1. That's not a favorable setup. For existing holders, stay the course. Execution has been solid and the catalysts ahead are real. Set a hard stop at $580. A break below that level on high volume would suggest the market is pricing in a significant miss on 2026 revenue or EBITDA margins. Also watch for any departure of CEO Duke Austin as a fundamental trigger for reevaluating the story. For new investors, wait for a better entry. The accumulation zone we'd get interested in is $640 to $680. That's where our fair value estimate of $639 and recent technical support levels intersect. At a midpoint entry of $660, the risk to reward improves to 2.1 to 1, with roughly 25% upside to our $825 price target against 12% downside. A strong buy, high conviction entry sits in the $545 to $580 range. Deep value territory is $405 to $480. Reaching those levels would likely require a broader market correction or a material execution miss. Key catalysts to watch. The next major data point is Q2 2026 earnings on July 30th. That's the first real look at whether VERT supply capital expenditures are on track and whether operating margins are holding. After that, gas power contract announcements in the back half of 2026. And the big one, the 765 kilovolt backlog announcement in the second half of 2027. A single large award there could trigger a meaningful re-rating of the share price. One-line summary, Quanta is one of the most compelling infrastructure growth stories in U.S. equities, but at $733.62, it's priced for perfection. 0.54 to 1 risk to reward. The right trade is to want this stock at $640 to $680 and to be positioned before the 765 kilovolt backlog announcement in the second half of 2027. Set the alert, be patient. If you found this useful, subscribe to the Value and Momentum portfolio for the weekly macro and market pulse and our high conviction setups. This report is for informational purposes only and does not constitute financial advice. Please conduct your own due diligence. Thanks for listening, and we will see you on the next one.